Today, the rental crisis and how not to fix it. Hello again, it's Martin North from Digital Finance Analytics. Welcome to the latest post covering finance and property news with a distinctively Australian flavour. And just before I start, a quick reminder that at 8 p.m. Sydney time, Tony Lacantria will join me for my DFI live stream, and we're going to talk about the latest from the markets, including property and also bonds, stocks and other investment classes. So much in play, so much to talk about. So join us and you can ask a question live via the YouTube chat. Well, the rental situation is getting worse across the country, driven by the pandemic-induced shrinkage in average household size as people demanded more space. This has effectively reduced the number of homes available to rent. Plus, many investors are lifting rentals to try to turn unprofitable investments positive, especially as capital gains on many apartments remains a pipe dream. CoreLogic reported that rents across Australia continue to explode, surging by 8.7% nationally and by 10.7% across the combined regions in the year to March 2022. With rental growth at 2.6%, outperforming value growth at 2.4% over the 3 months to March, national dwelling yields have recorded a 1 basis point rise since December at 3.22% and 2 basis points since the start of a new record low of 3.21% in January and February. Despite the recent rise, national rental yields are still 32 basis points below the yield recorded this time last year when it was 3.55%. Compared to the previous quarter, movements in yields have varied, reflecting the diversity in home values. Yields rose across Sydney, Melbourne and Canberra, but fell across Brisbane, Adelaide, Perth, Hobart and Darwin. Brisbane at 3.51% recorded the largest fall in rental yields over the quarter, while Darwin at 6.04% continues to record the highest rental yield amongst the capitals, followed by Perth at 4.34% and Canberra at 3.82%. At the other end of the spectrum, the Sydney yield of 2.48% and Melbourne at 2.81% saw a sharp decline in rental demand throughout the COVID period, and they recorded the lowest yields despite a small rise over the quarter. Perth recorded the smallest year-on-year change in yields, down just 6 basis points from 4.40% to 4.34%, following annual value growth of 10.6% and annual rental growth of 6.6%. This was followed by Melbourne and Darwin, where those markets recorded an 11 and 17 basis point fall in dwelling yields respectively. Hobart recorded the largest reduction in yields, from 4.5% in March 2021 to 3.65% in March 2022. CoreLogic says for the first time since August 2020, gross rental yields have also increased, albeit by 1 basis point between February and March. This trend is expected to continue as rent values increase faster than purchase prices. Eased international travel restrictions are likely to be a catalyst for continued growth in the rental market, as overseas arrivals such as international students and long-term migrants are typically renters when they first come to Australia. This leap in rentals is yet another manifestation of failed housing policy. Australia's growing army of renters are blind to our politicians, who always prefer to throw money at home buyers and other policies that inflate prices. Then overlay the increasing migration as the federal government plans to import some 235,000 migrants a year into Australia, which will dramatically lift demand at the same time as the volume of dwelling commencements has fallen sharply. Property Investment Professionals of Australia President Nicola McDougall warns that rental affordability pressures facing many households are only going to get worse, and soon, with overseas migration projected to soar over coming years. Where are these new Aussies going to live if we don't even have enough rental properties to house our current population? She asked. These trends have been driving the build-to-rent sector, which is adding a cabal of profit-dependent corporations to the housing market, which will inevitably increase their already monstrous lobbying power and pricing power. A new report at the AFR suggests that recent Australian buy-to-rent projects are charging a 20% premium on traditional rents. A Charter Kleck Kramer analysis of advertised rents at Mirvac's LIV Indigo BTR development in Sydney Olympic Park and rents for nearby private rental apartments shows the median one-bedroom, one-bathroom apartment rent is 19% higher than the equivalent build-to-sell unit, while the difference was 27% for a two-bed unit. The relatively small study gives independent confirmation of claims Mirvac has made about a 15 to 20% premium for its build-to-rent apartment model. The exclusion of rental revenue, such as the extra services a BTR landlord could charge for, did mean the gap with privately owned rental units could be even higher. This suggests the premium currently being achieved is likely to be even higher than the figures indicate. The study compared 22 build-to-rent and 30 build-to-sell one-bedroom, one-bathroom apartments that were advertised for rent and had the same disclosed internal floor area. And it also compared 18 build-to-rent and 19 build-to-sell two-bedroom, two-bathroom apartments. And Dr. Cameron Murray, in the recent economics lecture, said the next story we've been sold in the game of political pretend is that tax breaks are needed for corporate build-to-rent BTR housing projects. Somehow, if we replace landlords who own just a few properties and have them managed professionally by real estate agents with large institutional owners who own many properties and have them managed professionally by real estate agents, then, I don't know, something happens. We never seem to ask what exactly. Like the word affordability, build-to-rent is another long word, an exhausted idiom, hiding real policy aims. If the experience so far is anything to go by, this solution will turn out to be a multi-billion-dollar giveaway to existing large property owners with no benefits to housing occupants. There are two existing projects that show what outcomes to expect. On the Gold Coast is Australia's first and largest BTR at the former 2018 Commonwealth Games Athletics Village. Despite record-tight rental markets, this development of 1,251 dwellings was on a staged release strategy over 3 years. The manager of the project in 2021 said that they didn't want to flood the rental market. Instead, they left hundreds of brand new homes vacant for years to keep their rents up. Strangely, this project is government-owned, just not an Australian government. It's the Abu Dhabi Sovereign Wealth Fund who owns it. Maybe sometimes governments do like owning and building housing. In Sydney at Mirvac's LIV BTR project at Olympic Park, the rents are typically 10 to 30% above the local market rate. The rental prices there last year were $535 a week for a one-bedroom apartment, $615 for a two-bedroom apartment, and over $1,000 for a three-bedroom apartment. To maximise their economic return, they focused on the premium market with packaged gyms, facilities, appliances and services to sell a more hotel-like experience. This is what tax breaks on GST and land tax to encourage BTR landlords are going to deliver. I also wonder sometimes where all those sites for BTR projects seem to magically appear from. If you believe the previous rezoning story, there aren't any spare developable sites. The market for buying new homes can't be satisfied, but now there are many spare sites all over the country to allocate to BTR projects instead. Perhaps that was a lie, and there are plenty of development sites around, but the owners of them are looking for ways to improve the return on them with changes to the rules in their favour. In other words, BTR is another fake affordability policy favoured by the rent seekers for the rent seekers and aimed at sucking more lifeblood from the catastrophic market failure of Australian housing. And yet so far during the election campaign, the rental crisis has not really been mentioned, other than ScoMo suggesting that those renting should consider buying a property instead. It's frankly a mess, with long-standing consequences for households across the country. It's absolutely shameful, but the problem is that there are no real votes in it seems to me. Whereas, of course, talking up the property market and getting more first-time buyers dragged into the market is seen as a vote winner. This is a mess. Now, if you're buying your home in Sydney's contentious market, you don't need to stand alone. This is the time you need to have Edwin Almeida from Ribbon Property Consultants standing alongside you. Buying a property is both challenging and adversarial. The vendor has a professional on their side. Emotions run high, price discovery and price transparency are hard to find, and then there's the wasted time and financial investments that you make. Edwin understands your needs, so why not engage a licensed professional to stand alongside you? With RPC, you know you have experience, knowledge, and master negotiators looking after your best interests. So shoot Ribbon an email at info@ribbonproperty.com.au, and if you use the promo code DFAWTW/Martin, you can get a 10% discount offer. And it's time, things change. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.